Hello, everyone, and welcome back to our final session where we will discuss debt management. Just a quick overview of the session. I will discuss some of the rationale for issuing external support, debt specifically. I will cover some conditions for successfully using external support, as well as some of the commonly accepted debt management strategies. And I will conclude with key principles of using debt for financing infrastructure projects. As usually, I hope you will find this session interesting and hopefully take out something new and useful for yourself. Let's dive right in. Last time we discussed capital budgeting and we also covered capital budgeting cycle. And as I mentioned, one of the stages in the capital budgeting cycle is financing. Here is listed as stage 3, and this is where the decision will be made about alternative sources of financing. And generally we can divide this into two categories: using own source resources, current revenues or reserves, or using external resources such as debt and loan. And the decision will be probably an iterative process because the financing options will affect the kind of projects we can implement, so there will be a lot of back and forth. But the final decision will depend on many factors, and there is a multitude of different factors that will affect the choice of the government in terms of what actual resource to use. But I wanted to cover real quick some of the general arguments in favor of using external financing, such as debt. So governments consistently need to invest into their infrastructure. If it's not new construction, then it's maintenance. And it quite often requires substantial resource investment relative to their annual budget size. So this is one of the major reasons why they often turn to borrowing. And in the coming decades, there are estimates suggesting that infrastructure investment necessary to actually help economic growth and ensure consistent service delivery will be in hundreds of billions of dollars per year worldwide. And particularly the infrastructure investment needs are high in developing countries. So, and some part of it falls on the subnational governments, cities in particular, but a great share of that, one way or another, is financed through the national government. And very often their resources will be lower than the required capital investment. So this is one of the actual necessities that requires governments to use external resources. But there are also advantages to using debt versus own reserves or operating revenues. So when governments use debt, it allows them to invest into their infrastructure, into their capital assets when necessary, rather than waiting for when the resources become available. So this speeds up the process and allows them to achieve their goals much sooner. Otherwise, they would have to wait for a long time or substantially increase tax burden on existing taxpayers, and save their resources. So debt also spreads the burden over time. So not only current taxpayers if the government used own reserves, that means that the people who any taxpayers who paid taxes so far, they would be financing the entire project, and that puts all the burden on the existing taxpayers, whereas the project will last several decades and will benefit future generations who will not have to pay. So that's a disadvantage of using your own resources or your own savings and reserves. On the other hand, debt financing, if a project is financed with debt and then the debt is repaid through the lifetime of the project, it improves the intergenerational equity, and it also doesn't put as much pressure on current budget, and it protects current services. Another advantage is that almost any currency loses value over time. And if the government borrows in its national currency, not tied to any foreign currency, then the debt is repaid over time, and the future payments will actually, in real terms, have much lower value than current currency. So the debt is repaid in reduced value money due to inflation. So that's another great advantage. But debt can be a double-edged sword. Borrowing usually expands the financing capacity of a government, but it also entails some risks of insolvency. And some of the reasons for additional risks that debt creates include, for instance, over-optimistic revenue projections, economic cycles that reduce government revenue collections. It could be volatility of aid or transfers if we're talking about subnational government. And some governments are inefficiently collect their taxes. So, or their projects that they're financing can be can underperform and don't generate sufficient revenue. So the government can easily overburden itself with debt, hurting current services and disadvantage future generation, or even default on its obligations with dire long-term consequences for the entire country. So the government should need to think carefully about appropriate debt management strategies, which we will discuss further in the session. And first I wanted to turn to some of the conditions for successfully raising external resources. So there can be several rules of thumb for effectively acquiring and using external funding, such as debt. And in very basic term, the borrower, the government, should try to show its credibility and that it's a low risk investment for the creditors. But more specifically, a solid capital investment program with clearly defined and appraised development projects is a very important instrument for attracting funding, and that will be aligned with the objectives of the government, so that it becomes clear what exactly the money is used for, and all the risks can be taken into account. In addition to that, it's important to demonstrate that the external funds are used to finance target projects that are sustainable over a longer term, and that have sufficient budget for operation and maintenance, so that they don't require additional injections from the operating budget. So, and if the project is intended to be self-sufficient, not all of them are intended to be self-sufficient. Some projects will not pay for themselves, some with that provide wide social benefits. They may not be self-sufficient. So, but those that are intended to be self-sufficient, it's important to have a solid financial analysis of this project and its projected revenues. So financial feasibility is actually vital to borrowing funds for projects that are expected to generate enough cash flow to service the new debt. So, and quite often observers note that in developing countries, not enough attention is paid to financial feasibility analysis. And the problem is that overlooking these aspects and making over-optimistic projections can cause severe financial problems to the government, because it will eventually require to use its own operating revenue to finance the project, and obviously hurting the current services. So these feasibility studies should have detailed and thorough financial analysis, including realistic assumptions about future revenue flows and risks. It should have sensitivity analysis, testing the projections for revenues and probably maintenance and operation costs under different assumptions, under different economic conditions, socio-demographic trends, and whatever is relevant for a specific project. And feasibility studies should also have instruments and government commitment for effective collection of the revenues that the project is expected to produce. And all of these aspects are essential for assessing the financial feasibility of the project. So finally, it's important to provide for the government timely and high quality financial reporting. It's important to have a clear balanced budget that is easy to understand, and an operational surplus so that the revenues exceed expenditures. All of these are important to make case with potential financiers, or that the government is reliable and will be consistent with its plans. So in terms of available alternatives for raising the capital, governments usually have two categories of resources. One way they can do that is tries to raise capital domestically, and they can borrow from local commercial banks or issue bonds in domestic capital markets, attracting capital from a different set of creditors, including local businesses that are located in the country, citizens, and in some countries pension funds and etc. So, but banks not always have sufficient capital to finance large capital projects of a central government. And capital markets in some countries may not be advanced enough to absorb central government bonds. Usually these domestic capital markets need to be deep enough, efficient, and well regulated to provide access to long-term local currency finance. And this is not the case in many countries where the local capital markets remain underdeveloped. So, and this can be one of the reasons for government trying to raise funds from international capital markets. And international capital markets are obviously much wider, and they offer a great variety of financial instruments and give access to private capital around the globe. So, but there are some challenges with access to credit markets, and especially international credit markets. So some services provided by the government may not be very attractive to private investors. Services like water supply and solid waste plants, for example, may not be attractive to private creditors who may fear that the projects have limited cost recovery, or particular loan gestation will take a long time to really get their money back. And governments often have a weak financial position with a small budget surplus and high liabilities and unpredictable aid if they rely on aid. So if that's the case, then the access to capital will be very limited, and it's either no borrowing will be possible, or it will be its debt will have very high interest rate if there are problems with financial position. And most importantly, one of the important things is that in order to resolve information asymmetries between the borrower, the government, and potential creditors, it is almost a default assumption that the government will obtain a credit rating, and which will estimate its credit worthiness and will have a clear indication how likely the government is to repay its debt. And this credit rating is costly, can be very costly to smaller governments, and may be difficult to navigate, particularly for first-time users. So next I'm going to talk a little bit about the credit rating. So in a nutshell, the credit ratings are an assessment of the credit worthiness of a given government or its debt issue made by one of the recognized credit rating agencies. And very simply, the rating indicates the risk that a particular government will not pay the bond's interest and principal on time. And the rating can be assigned to a specific debt issue, or it could be assigned to the issuer itself. And if the issuer pledges its full faith and credit, its taxing power to support the debt issue, then all the debt issues supported with its taxing authority will usually have the same rating for a certain period of time. And rating matters for one important reason. It's one of the most powerful predictors of the interest rate on debt. Low ratings indicate that there is a high risk the government will not repay its debt and its principal and interest, and as a result, the interest rate will be very high. On the other hand, if a government receives higher credit rating, the interest rate is going to be much lower. In addition to that, institutional investors, basically organizations, quite often are restricted from lending to governments whose credit rating is below certain rating threshold. Usually it's below B, triple B or double B, and I will discuss this in future slides. So sometimes it makes sense for a government to try to obtain several ratings in an attempt to get a better score, in hoping that one of the credit rating agencies will give a better score. But the downside of that is that every application for a rating will cost money. So about 90% of the global market is over 90% is graded by the big three credit rating agencies, which are Standard & Poor's, Global Ratings, Moody's Investors, and Fitch Ratings. And next, let's take a look what these rating agencies actually analyze, what kind of indicators they use to assign the credit ratings, which again are very important because they will predict the interest rate if the government was to raise capital from the international markets. So if the government wanted to borrow internally within the country, it could use any indicators to show its creditworthiness that it prefers. But if it wanted to tap into these international financial markets to raise capital, it would highly likely need credit rating, which evaluates its financial condition based on specific indicators. And these indicators are different from US states, for example. So these credit rating agencies, the major three agencies that control over 90% of the market, they have different rating methodology for the United States and then for other countries around the world. So here let's consider Standard & Poor's as an example. There is also Fitch and Moody's, and S&P is one of the leaders. It controls about 40% of the market. And let's see what kind of indicators they take into account. And the first one is listed as institutional and government's effectiveness. And here they look at how stable public policies are and how predictable they are. They also evaluate the government's transparency and accountability. And they also check previous debt payment culture, how consistently the government has been paying its debt. They also may evaluate the common checks and balances within the government, whether there is the branches of government are sufficiently powerful and there is no one branch that controls the entire operation. The legitimacy of the authority, to what extent they were elected rather than holding power, and the level of corruption, and to what extent the government provides timely and independent, reliable statistical information. They may also take a look at the probability of some domestic conflict, which of course will affect the ability of the government to repay. The next one is they will look at the economic structure and potential growth prospects of the government. And this is basically focusing on economic, it's an economic assessment of the government. So they can take a look at the income levels, how they changed over time, what the projections are, the economic growth prospects, and as well as economic diversity and volatility, to what extent the government tends to rely on specific industries. If there is one dominant industry, like natural resources, it may present substantial risk in the future. So if, say, for example, if 20% or more of GDP accounts for a single cyclical industry, or if it's vulnerable to natural disasters, that would be usually a red flag. Next is what they call external liquidity and international investment position, which is external assessment. So they will check to what extent the currency is used in international transaction and to what extent it's a reserve currency in any countries. They will evaluate the gross external financing needs, to what extent the government actually relies on external borrowing. And the more frequently government turns to external resources, it may be indicating a problem for the government not being able to finance itself within the country. So the next one is fiscal performance and flexibility. So as well as debt burden. So this is generally would be called a fiscal assessment. So they can evaluate the share of the government assets that are liquid, their liquidity status, and liquidity is how quickly an asset can be converted to cash. So they will also evaluate the ability to raise taxes if necessary. Would the government be able to increase taxes? Is there public opposition? Is there some other obstacles on the way to increase taxes? They will also evaluate to what extent, what share of public spending is actually mandatory, which is predetermined by law. For instance, debt service is basically mandatory because the government cannot just avoid paying it. And pension to some extent are mandatory. Some governments may have obligations to finance maybe medical coverage for their employees, and the more employees they have or retirees, as is the case in the United States, Medicare taking up a large share of the federal government, and it's not subject to changes within the budgetary process. They would have to change the law, so it's considered mandatory. So this mandatory, the larger the mandatory spending, the less flexibility the government has, the less discretionary resources they have. So, and within this parameter, they will also look at the debt burden as a percent of GDP, and as well as service cost. How much do they pay annually to service their debt? So the last parameter is monetary flexibility or monetary assessment. So this is something I mentioned in the previous discussions, and it's the ability of the government to actually effectively coordinate monetary and fiscal policy, which are usually different parts of government are usually responsible for these ones. Monetary is the responsibility of the central bank, whereas fiscal policy is done through the budgeting process by the executive and legislative branches. So here they would evaluate the ability of the government to actually coordinate, because these can cancel each other out, leading to zero net effect. They will also consider different most recent inflation trends. So it's important for the government to have the ability to increase the interest rate within the monetary policy, or they can apply some kind of exchange restrictions if necessary. So the flexibility that the government has and the level of coordination between monetary and fiscal policy is an important factor here. So this is a general overview, and each credit rating agency has a document where they discuss their sovereign government rating methodology. And whereas it may seem clear from the instructions from these frameworks what indicators they look at, the ratings usually combine quantitative analysis, such as share of GDP, debt as a share of GDP, the operating budget balance, and so on. So they combine these quantitative indicators as well as judgment subjective judgment about the capacity of the government to repay the debt on time. So, and it's not exactly science, and it can be subjective at times. And the experts who are involved in the evaluation and rating assignments play a fundamental role in what rating will be assigned. But once the rating is assigned, they publish the results with specific scores or rating grades. So and here is an example of the letter grades that these credit rating agencies assign after they conduct their assessment. So these are not all grades that exist out there. There are grades that are lower than BBB, different C's and even D's. But here we have only investment grade ratings. This is because many institutional lenders are not allowed to lend money to governments who have a rating below BBB for Fitch and Standard & Poor's and Baa1, Baa2, Baa3 for Moody's. And but they usually would be allowed to lend money to governments with that type of rating. And AAA here for all three, it's AAA is the highest rating, and it's indicating that the government is particularly reliable. And the lower we go, the less reliable, less credit-worthy the government is, and the more risk there is that it will not be able to repay its debt obligations, and as a result, it will have much higher interest rate. So, is it always worth for a government to get the credit rating? Well, there are some important considerations to make that public finance professionals indicate. So let's take a look at these. So they recommend, at the very least, the government should do a simple cost-benefit analysis, comparing the cost of obtaining the rating, the actual fee, to the potential benefit, which is savings from lower interest rate if they have the rating. So, and fees vary from agency by agency, and the government should carefully consider all three well-known credit rating agencies and try to negotiate with them the fee before requesting a rating. Another important thing to keep in mind is that there is a formal credit rating process which takes over a month usually, and perhaps up to 6 weeks, and it may include multiple in-person meetings with high-level government officials. It will require a lot of virtual meetings, phone calls with rating analysts, and who may also request a project site visits. So they would like to see where the capital project will be implemented. And all of this will require additional time and resources from the government officials. And an issuer must prepare in advance that it will be required to commit these resources. So there should be additional staff put in place, and there probably will be additional costs. And this can be particularly burdensome for first-time issuers who will not know what exactly is needed, who will need to learn on the go, and it will probably take much more time. In addition to that, issuers, when credit rating is assigned, when the evaluation happens, issuers are expected to provide a great deal of different information to the rating agency. And it may include, it depends on the agency, the specific indicators, but generally speaking, they include different aspects of history of the issuer. They may ask formal policy about the structure of management and governance. They may also review multiple years worth of budget documents, financial policies and procedures, and previous documents for debt issues, as well as audited financial statements. So before requesting a credit rating, the government officials should evaluate whether or not these documents are available and how much burden would it be to provide this kind of information that is very often requested by the credit rating agencies. So Another thing to keep in mind is that in general, a debt issue with a lower par amount, basically smaller debt issue, may not benefit from a credit rating as much as an issue with a larger par amount. So the credit rating fees vary with issue size to some extent, but the rating is actually more cost effective for larger transactions because it's not a perfect correlation. And so the bigger the debt, the more beneficial it may be to get a credit rating. Another aspect is the more frequently an issuer plans to issue debt, the greater the potential benefit there will be from obtaining a credit rating. So a more frequent debt issuer may benefit from expanding its investor base in order to successfully finance a large debt program. And a credit rating may help attract a greater number of investors to a particular debt issue. So if the government decides after the initial evaluation that it's worth getting the credit rating, and the credit rating is not as expected, there is a way for government to improve the rating, not by improving the indicators upon which the rating is actually based, but by buying an enhancement like an insurance or securing a guarantee from another government entity or an institution. So in this case, the insurer or the guarantor may step in and continue debt service on behalf of the government in case of its inability to service the debt. So the guarantor may pay just a portion, like a certain percentage of the interest due, and the debtor may absorb the loss, or the guarantor may pay the entire debt service until the government recovers its financial position and is able to pay the debt again. So these enhancements may in the international market may be available from International Finance Corporation or Development Bank of Southern Africa, and also USAID has established a facility called the Development Credit Authority, DCA, to encourage the development of credit markets in emerging economies. So today, actually, the DCA has a presence in most developing countries. And in Zimbabwe, at least in the past, it was practiced to issue municipal city bonds with sovereign guarantees. And there was an instance in 1998 when Harare actually had a central government guarantee, but the central government actually withdrew its guarantee of local bond issues, and as a result, the interest rates jumped immediately, and it became extremely expensive for local governments to borrow. These guarantees, I think, were restored again by the national government in 2001. So these enhancements offer this opportunity to improve the credit rating. The downside, of course, is that enhancements cost money, and it may or may not be worth buying them. And a careful cost-benefit analysis, case by case, as usually, is necessary. So just to give an idea how the world is rated, here's a map with ratings on it from the S&P Global, and you can see there's a great deal of diversity in terms of credit worthiness around the world. So the AAA countries with the highest rating possible include Canada, Norway, Sweden, Germany, Switzerland, Australia, and USA is one level below the highest, so it has AA plus rating, as well as many other countries. And there are many countries that are actually not rated by S&P, so that's a large part of Africa and Middle East. And Zambia is actually one of these countries that is in default right now, and it's in red. So so this is what kind of ratings are available around the world for different countries that have been assigned as of the end of 2021. But in any case, with the credit rating or without it, if the government decides to turn to external financing and it actually issues debt, it is very important for it to follow some sound debt management strategies. And a debt management strategy is like a plan that the government intends to implement over midterm to achieve some desired composition of the debt portfolio. So it ensures that the government's financing needs and payment obligations are met at the lowest possible cost, consistent with a reasonable degree of risk. So debt management strategies help governments decide how much to borrow, what the best combination of debt instruments is, and what actions to take to ensure that the debt stock and debt service don't become too large to be paid on time. So, and usually a reasonable debt service strategy would include several objectives. For instance, one of the primary objectives is to ensure that debt obligations are in line with repayment capacity. So this repayment or borrowing capacity is the maximum amount of new debt a government can issue without hurting its ability to deliver services and serve existing and new debt. So it depends on how much money it has to repay to service the debt today. It's reduced by its commitments payable in the future, but borrowing capacity is increased by its by the government's likely future revenues. And more specifically, borrowing capacity could depend on several factors, including economic and financial prospects of the government. So when the government prospects for economic activity and tax receipts accordingly are good, borrowing capacity is greater than in a time of economic crisis or scarce revenues. So the characteristics of the new loans or bonds, interest rates, and maturity also matter for debt capacity. If the government can issue debt with long maturities and low interest rate, the borrowing capacity will be greater, holding all else equal. It will have a better cash flow. So capacity also depends on the structure and the size of existing debt stock. If a government has an outstanding debt where various debts coincide and actually include a cluster of payments at the same time at some point, it is likely that debt service will absorb an important portion of the government's current revenues. So, and sometimes a government obtains a new debt to restructure the existing stock of the debt, stretch the average maturity terms, and lower the annual burden of debt service to improve its borrowing capacity. So that's one of the strategies. So, and for subnational governments, their borrowing capacity can be affected by the institutional framework and the limits imposed by the national governments or by the local voters. So another important strategy is to set aside or set up a specific debt service fund, and sometimes called the sinking fund, which would carry from several months up to probably 1.5 times the annual debt service. And it depends on the government, on how volatile its revenues are, but this fund helps to protect against these fluctuations. And the process, this fund should be actually formalized, it's recommended, to avoid misuse of the reserves. It should be regulated what the reserves can be withdrawn for. Usually they will be earmarked for one specific purpose. So, and this formal process will also help ensure that the consistent contributions are made if it's stipulated by the law. So, and another important aspect of debt management strategies is when different debt alternatives are available, governments should compare them, taking into account the principle of time value of money. For example, net present value is a very useful, commonly used instrument for assessing how debts with different maturities and conditions compare, taking into account current market rates or whatever other relevant discount rates the government prefers to use. So Banks, commercial banks that are engaged in lending on a regular basis, they're often better informed and more sophisticated than particularly smaller governments, and they may offer complex alternative proposals with various interest rates, different repayment schedules and conditions. So this net present value analysis helps in comparing these competing offers by showing the true actual present cost of the debt. Another important phenomenon that governments should keep in mind is called balloon payment risk. So borrowing capacity that I just discussed is an important matter that can be tested by simplified mandatory indicators such as debt stock, existing debt or new debt as a percentage of the net operating revenue. But for larger borrowing, a more detailed cash flow analysis is required that covers the entire repayment period of the new debt. So governments quite often calculate the historical trend of their debt service and net revenues, for example, and to justify their debt capacity. But these projections, looking in the back mirror, may ignore or hide potential balloon payments, which may occur because, say, some grace periods of the various loans or the final payment of bond principals coincide and cause an extraordinary expenditure for a few years ahead. So it is also possible that if the government debt has a variable interest rate, that certain events stipulated in the debt agreement occur and they can trigger an increase in interest rate and as a result increase the debt service cost. So this results in what they call balloon payment risk. So in this case, good feasibility studies with thorough financial analysis and cash flow analysis for the entire loan period are vital to avoiding or mitigating these balloon payments. Creditors can also mitigate these risks by requiring the borrower to set aside a debt service reserve fund that gradually deposits funds for multiple months, from 6 to 12 months, and of debt service. So in the case of revenue generating project, so creditors may request that the borrower set up an escrow account and deposit in it all revenue collected from the project and disbursing the debt service first before all other payments are due. So some governments turn to capital markets regularly, and it makes sense for them to have full-time in-house staff engaged in this process and accumulating experience. But quite a few governments, actually, particularly smaller governments, subnational governments, issue debt infrequently and don't have in-house expertise. And it makes sense for them to benefit to turn to some external assistance in debt management. And this could actually save money because timing the debt issue may be difficult if they are turning to capital markets because the interest rate consistently fluctuate, and there is a chance that the inexperienced government officials may be taken advantage of by the creditors or by whoever they are dealing with. So, and public finance professionals suggest that less experienced government officials, particularly subnational governments, may find it helpful to turn some official external support from such entities as World Bank, African Development Bank, and European Bank of Reconstruction and Development, as well as USAID. So governments have substantial needs to expand infrastructure and provide basic public services. So given the long-term nature of capital infrastructure projects, it is possible and often efficient to use long-term funds to finance this project. So this ensures, as I mentioned, that the generations that will enjoy the benefits of the project are also those who pay for them. So regardless of the experience, the amount of experience they have, all public debt issuers will benefit from following some of the key principles of debt financing. So one of these principles is that the government should select the projects that are worthwhile to finance with borrowing. These projects should be able to pay for themselves with a substantial safety margin. The government should also make sure that the government itself has a good financial position, say a substantial net operating surplus, again with a safety margin. Because the project cannot pay for itself, the government should be able to step in. And the government should project their balance sheets, comparing assets and liabilities, and find out whether new borrowing is in line with the constraints imposed by the environment in which they operate. So government should compare different forms of borrowing, whether it comes from the banks in terms of loans or debt issues from the capital markets. And quite often governments can use a combination of different sources if one source cannot fully fund the desired project. And as I mentioned in the past, it's a good strategy to use net present value to compare different alternatives, and it is important to take into account the principle of time value of money. So in terms of public-private partnerships, these have been grown, they include different arrangements, and they've been grown in popularity in 30 years. And they are often an efficient way to finance expensive infrastructure projects, and it's important to understand what enforcement provisions are needed to be sure that public sector actually gets its fair share. So in the past, there have been instances where it was actually difficult to evaluate to what extent the government gets its benefit. So the public PPP should be used only if it's fully understood, and if the arrangement is fully understood by the government officials, and if the benefit can be clearly defined and measurable, and there is a way to ensure that the government actually receives its benefit back from these partnerships. Another rule that it makes sense to follow is that the debt should be used to finance only long-term capital investments. That should not be used for covering operating budget gaps. So if an operating budget has a gap, the government has two options: either reduce, cut spending, or increase revenues. Debt should be used for any opportunities that actually pay for themselves, that will cover the cost of interest. Otherwise, debt makes the government worse off. So capital projects often pay for themselves, but spending on current operations such as salaries or maybe inventory and supplies rarely yields the returns comparable to the cost of borrowing. So operating expenditures must be funded with taxes and current own source revenues. And if not enough, if the current own source revenues are not enough, the government basically can't afford it. So, and if there is access to short-term borrowing, it usually, if we convert the rate to the annual rate, it usually has relatively high annual rate, and it should be used only to deal with absolute emergencies. And yet another rule, the golden rule, is of the capital finance, is that the debt payout period should not exceed the useful life of the capital asset. So the project is paid for while it's in use, and it's not really equitable, and it's not financially responsible to have to pay for the asset when the asset has already been exhausted. So the length of the debt, the maturity rate, should fit the useful life of the project, and the debt service should be generated from the project. So, and the debt service, of course, should not exceed the government capacity to borrow, either in terms of current service level, like a % of revenues, or overall stock as a share of the economy, like total debt as a share of the economy per capita or its own revenues. So something I talked about. So that is all that I had for you today, and thank you for your attention. I hope you found some of the information useful, and best of luck in your future endeavors.